So I was going through the articles for this deep dive. The sources, they kept pointing to this totally different power player.
The insurance industry.
Right. Insurance. I mean, I think of them as the people I argue with over a fender bender, but these reports are calling them the shock absorber of the whole global economy. That feels like a huge leap.
It does sound like marketing, but if you strip it back, it makes sense. Insurance is basically a social contract. It spreads risk across time, across society, but it works. We can build things, run businesses. The problem, and what the sources are getting at, is that climate change is breaking the math that makes that contract work.
Okay, so let's get into that math. I saw this term popping up everywhere. Reinsurers. For anyone not deep in the financial world, who exactly are these guys?
Think of them as the insurance for the insurance companies. So if a massive hurricane, say, wipes out half of new infrastructure, one single insurer might go bankrupt trying to pay all the claims. So they buy their own insurance from a huge global firm, a reinsurer, to cover that kind of catastrophic risk.
So they're the ultimate backstop.
Exactly. And because they are on the hook for the biggest of the big disasters, they don't really care about political debates. They just care about data. And this is the fascinating part the sources highlight. While politicians are arguing, the reinsurers are just calculating. They're pricing the future cost of it all.
That was the real aha moment for me. They're not working with rhetoric, they're working with balance sheets, but the sources say their old models are failing. They use this phrase, nonlinear compounding risks. That sounds bad. What does it actually mean?
Sure. An old model might assume a fire and a flood are separate events, isolated. Compounding risk means the dominoes are all connected now. So climate change increases flood risk. The flood takes out the power grid, the outage crashes the local economy.
And the housing market collapses. It's a spiral.
It's a spiral. It's not one bad day anymore. It's a systemic failure.
And when that spiral starts, the insurers do something that makes perfect business sense but sounds awful.
It's called the moral hazard of retreat. That's the term for it. If a place gets too risky to insure, they pull out. Financially, it's the only logical move they have.
But the social cost is huge.
It hollows out entire communities. I mean, if you can't get insurance on your house, you can't get a mortgage.
And property values tank.
They crater. And guess who's left holding the bag? The government. Which, means the taxpayer.
Okay, but there's a flip side to this, right? The sources talk about pricing as regulation.
That's the optimistic take, yeah. Premiums can be invisible regulators. If it costs you 10 grand extra a year because your home isn't energy efficient or flood proof, you're going to make some changes pretty fast.
One article called it underwriting as a political act. I love that phrasing.
It's basically de facto regulation. You don't need a new law to stop a coal plant from being built if nobody will insure it.
You literally can't open without coverage.
You can't. And you have to remember, these companies aren't just insurers. They're some of the biggest investors on the planet. They manage trillions.
So they have two levers they can pull.
Two massive levers.
Right.
They can refuse to insure projects they see as too risky.
Like new oil pipelines.
Right. And they can also refuse to invest their trillions in the companies behind those projects. They could starve them of capital.
But this is where it gets complicated because the readings point out a huge credibility gap.
The greenwashing.
Yeah.
You have these major insurers publishing these glossy ESG reports, setting net zero targets. But then you look at the data, and some of the very same companies are still underwriting massive fossil fuel expansion projects.
It's a total conflict of interest. They want the premium payments now, even if the risk from that project bankrupts them in 30 years.
It's a classic short-term versus long-term problem.
So what's the solution? How do you hold them accountable? The sources mention something called insured emissions.
That's the key metric. It's about transparency. It's forcing companies to disclose not just the emissions from their own office buildings, but the emissions from all the projects they insure. If you insure a coal mine, those emissions are on your ledger. That's the only way to see who's actually walking the walk.
It really does reframe the whole crisis. We're all waiting for politicians or voters to make a move. But it might be the actuaries who end up deciding our collective future.
And that leads to the final question the sources pose, which is, well, it's pretty haunting. The question isn't whether insurers will change. The math, the raw data, it demands they do. It's whether they'll change fast enough to keep our world insurable. Because if the risk becomes too great, if the system itself breaks, what happens to that social contract then?
Something to think about the next time that insurance premium comes out of your paycheck. Thanks for this deep dive.